Well, we would like to welcome everyone to Echelon's Q1 Top Pick portfolio presentation. You will see we can highlight that for the quarter, we had a very strong performance, rebounding and gaining 19.5% on the quarter, which is very attractive in terms of absolute measurements, but also in terms of relative measurements, wherein you can see from my cursor here where the TSX small cap is ahead by 8.4, the broader TSX ahead by 6, and the TSXV declined by 4%. So very pleased to note the strong exit to the year. Very disappointed to reference that on the year, however, the top pick portfolio declined by 28%. That is within the context of the TSX small cap declining by 9.3% and the TSXV down by 5.8. Sorry, TSXV down by 39.3%, the TSX down by 5.8%. So we regret the underperformance on the year. We do highlight and are pleased with the recovery and strong performance on the fourth. Our portfolio has stuck with its mandate of small cap, catalyst rich stocks where growth is a clear focus. That has not been the style of the marketplace. You will note that for the year, value stocks, they significantly outperformed growth stocks, with value stocks ahead by 7.4% and growth stocks declining by 30.1%. So against very significant headwinds, we are pleased nonetheless with our performance. And we turn people to our 3-year and 5-year track records, which are arguably the more relevant measurements of our acumen. And here we do note over 3 years, we are ahead by 49%. 5 years, it's an impressive 79% with significant alpha versus both the TSX and the TSX small cap returns for those periods. In terms of the top performing stocks on the quarter, we can highlight that Silverex, nominated by Gabriel, was the top performer, the star on the quarter, ahead by 73%. Gabriel will be addressing this. Diagnose was submitted by Stefan, another great pick, ahead by 65% on the quarter. Stefan will be talking to the catalyst behind this return. In terms of underperformance, Verano declined by 32%. Andrew will be speaking to this. And Converge, a name that I had submitted into the portfolio, a past winner within the portfolio, it declined by 30%, which never would have anticipated. Clearly wouldn't have had in there should we have been anticipated. But just in terms of the context of it was down by 30%, while something of a peer, Quisitive gained by 48% on the quarter. We can dive into this in a bit when we get to that section. In terms of looking ahead, which is why we are here, we note that the names from the Q4 were carried into Q1 23. We generally do not have that significant turnover within or across quarters as we pick names that we believe will be winners. And we are sticking with our names going into the quarter. Now, in terms of moving us along, I will jump right in on those technology stocks, which were recommended. Here, we did note that Converge was down by 30% on the quarter. We think that there is a compelling argument for investors to be acquiring the shares here at the price given here at $4.59, more recently $5. In terms of the fundamentals, it is to our measurement, a success story, 35 acquisitions since the September of 2017, where they have a copy, paste, accrete formula that just gets better math the bigger they get. In terms of the size factor, we think that the market recognizes to an extent that they have now become a $3 billion revenue run rate company. We don't think that the market recognizes, however, that in doing so, they haven't just gotten larger, but they've gotten smarter, i.e. they have gained critical scale within growth verticals. getting scale within verticals will allow them to introduce more higher value, higher margin services, managed services to be specific, within those sectors. So we believe that will set up the company for enhanced organic growth within 2023 and beyond. In terms of the stock, it was a quarter where the company responded to inbound inquiries in terms of takeover inquiries. The company came out with an announcement that they had formed a special committee to review these offers. They are in the process of reviewing prospective offers for the company. We expect further details from the special committee within the quarter. Our view, there will be interest. Interest should be in the neighborhood of $10. If it does not come forth as such and is disappointing, we do believe that the company has options at its disposal. And that all comes about from their 17% yield, not dividend yield, but free cash flow, i.e. cash flow available after CapEx, all requirements available for their discretion. At their discretion, they could institute a 5% dividend yield, or a dividend that would correspond to a 5% yield. That would take up roughly 1/3 of their free cash flow. They could institute an aggressive share repurchase. They could also resume acquisitions that would be internally financed. So we do think there will be interest. In the case where there isn't interest, there are options available to the company. And furthermore, we have a very bullish view on the fundamentals and the valuation. Trading at 5.6 times 2023, i.e. current year EV to EBITDA, while the Canadian peers are 8.6, European peers are 8.7. We've just introduced our 2024 valuations, and that multiple then goes down to something like 4.5. Compelling value where we do see momentum. To move along, the next name, which was a star performer in the quarter, was Quisitive. Here, basically, we see organic growth of 15% being sustained. There are reasons to support that bullish outlook. In terms of the marketplace, probably reflecting a less aggressive outlook. There are some concerns about cloud demand slowing, but we would note on the most recent quarter, Microsoft announced Azure volume growth ahead, 42% year on year on an FX adjusted basis. The company has a 6-month window on demand and has recently told us, i.e. the other day, that they see no abatement in that demand. So we see one of strong organic growth, and we see an interest by the company of introducing acquisitions. However, ahead of introducing acquisitions, we believe the company will explore options to lower its cost of equity. That could see the company sell a minority stake in either its IT services or in its payments group, where the largest asset is BankCard. We have BankCard valued at 12 times its operating cash flow, or EBITDA. There was a recent $1.3 billion transaction for a company that arguably is a lesser quality company than BankCard, done at 24 times. So our sum of the parts valuation would be $1.60 plus. Our longer term discounted cash flow valuation would be $1.60 plus. For those who don't want to go to those sum of the parts valuations or DCFs, you can take your near-term benchmarks in terms of free cash flow, where it has a 10% yield, or enterprise value to the EBITDA, where it is at 8.8 times. We do see catalysts. We stick with the name. Playmaker, whenever management here presents, they receive accolades. A very strong management team, very good at communicating their strategic plan and executing to that plan, very good at beating analyst forecasts on the quarter. There is a strong tailwind here where we had the FIFA World Cup that will lead to, we believe, outperformance on Q4. We believe that Q1 will be very strong on the strength of the Super Bowl, March Madness, and a new acquisition that is seasonally strong within that Q1. So we like this space in terms of digital sports and viewership serving into the growth marketplace spurred on by the legalization of betting. Valuation is attractive at 8.6 times its operating cash flow or EBITDA, but really you're betting here on a category and on a management with a track record of making accretive acquisitions. And frankly, the bigger they get, the greater the cross selling synergies they bring, efficiencies they bring to the table. Very strong name here. It's one that we would buy and just, you can forget about it. Anyways, with that, I will pass it over to Emmer. Emmer, over to you, please.
Thanks, Rob. We're sticking to our guns as well with ReadyShred and Echelon. And there I'll tell you what I say every quarter. We're always looking at how much upside we have relative to downside risk. So these two names aren't necessarily the stocks where I have the most upside, but they screen best when looking at upside relative to downside. So the first one is ReadyShred, ticker's KUT. Since our nomination a year and a half ago, they're up 7%, and the TSX small cap index is down a good 10%. So not so bad, but we still have a lot of upside. Our target price is $8.25. We've got, which implies like more than a doubling from current levels. For those who are new to the story, as the name implies, it's a shredding business. So it's the secure bins you have in the office where you throw confidential documents. They come pick it up, shred it, and they sell the shredded paper. It is very high margin. It has boring recurring revenues and both organic and M&A growth. A lot of the ingredients essentially that we look for in a quality operation. Why do we like it so much is the stock's down 30% below its previous highs, which were like pre-COVID. And we feel they're down because it's a total disconnect because it's microcap and not a lot of people are paying attention to microcaps in these markets, whether it's quality or not quality. So since like their pre-COVID highs, what has happened is sales went from a run rate of $20 million to $50 million. Then EBITDA went from a run rate of $5 million to close to $15 million. So they tripled their EBITDA, and the stock is still below, like where it was trading. In terms of actual valuation, stock trades at 6.5 times EBITDA. The larger peers trades at 13 to 14 times. And that's a very wide discount. We have charted that discount on the chart you see on the top right-hand side. And as you see, we are over one standard deviation below historical levels. So we think it's a steal at these levels, and you've got pretty good downside protection here. With that, I'll pass on to our second pick, Echelon, ticker CGY, $85 target price. If you look at a longer term chart, like 3 or 4 years, this stock has been one of the top performers in the small cap tech and industrial space. They've doubled in the last 3 years, despite the market turmoil. Then if you look at it in the past year, it's up 14%, which is not so bad in these markets. So in terms of what the company actually, what they do, it's a diversified operation with 4 different divisions, mostly tech, industrials, and health. And they mostly cater to governments across the world, mostly Canada, both like federal and provincial government, but it's mostly government revenues. So if you're thinking about a scenario of the world potentially going into a recession, private sector slowdown, this name is a pretty good one to own. Now, the holdco structure with 4 different divisions is extremely important in that it allows the company to make very small tuck-ins in each of these divisions. And they're not really risking the company by doing a large transformative acquisition. So it's a series of like $20 to $30 million acquisitions, no trouble integrating them because It's different leadership teams for each division. And they're not really competing for the much more expensive acquisitions where there are competitive processes with much higher valuation multiples. So when I'm sort of looking at it today, M&A story, it's a buyer's market in that valuation levels of targets are down like a good 50%. Oh, and they've got like $200 million of liquidity they could deploy into M&A. So we really like it in this environment, justifying our continued top pick endorsement. With that, I'll pass it on to Andrew on cannabis.
Great, and thank you, Amber. Appreciate it. So just on the cannabis names quickly before we move into our top picks here. Q4 was another challenging quarter for the cannabis markets. Our primary cannabis benchmark declined by 13.8% on the quarter. Since the majority of our coverage is US based, I think it's also important to note that our US tracking group, which includes many non-coverage names as well, lost an average of 35.1% in the quarter as tough capital markets conditions have persisted and hopes for federal reform south of the border faded. Our Q4 top picks outperformed the benchmark modestly with a decline of 11.4% on the quarter, avoiding the worst of the selling pressure. But we would still hope for much better and more, hopefully more profitable capital markets conditions ahead. So moving into our top picks for Q1 of 23, we're returning with our same two names. So let's start on a high note with High Tide, which was the top performing stock in our coverage universe in Q4 and one of the few cannabis companies to post a gain in the fourth quarter with a return of 9.4%. The story there really remains the same. High Tide continues to amass market share on the ground. It reported same-store sales growth of 46% year over year in its most recent quarter. That compares to an industry average, which saw same-store sales growth decline by 24%. So it is massively outperforming peers in the marketplace, many of which are now struggling to survive. And it has a solid organic performance in addition with the plentiful M&A opportunities created by these tough conditions have allowed High Tide to grow its overall top line by 98% year over year, effectively doubling revenues. It remains one of the fastest growing Canadian cannabis companies. It remains exceptionally well positioned with a strong balance sheet, with one of the largest cash positions it has ever had in its history. And we see a continued deep pipeline of M&A opportunities at attractive valuations being created by the difficult capital market conditions. In terms of catalysts, what we're looking for in Q1 is, first of all, the company reporting its fiscal Q4 results, which should be announced on January 30th. We expect the quarter to be solid, and management should also provide a first update on the Cabana Elite program. This is a new paid-for membership subscription model that High Tide launched in Q4. We expect this to generate recurring high-margin revenues, though the company for the first year will be investing in growing this program. So still some time for that to become a material contributor to the bottom line, but we expect to see some solid initial uptake in the early months of that program. In addition, we're looking for store growth on both an organic and inorganic basis, and M&A in international markets where the company has been active through e-commerce and hemp-derived CBD products offers another avenue for growth and potential method to deploy its cash balance that it has on hand. In terms of the company's valuation, it trades at 8.9 times our 2023 EBITDA estimates. It's a fairly narrow peer group, so it's hard to compare between peers. However, we do find this to be an attractive valuation multiple for a company that just recently nearly doubled revenues year over year, and one that is beginning to emerge from the worst of the competitive pressures with room for expanding profitability from both retail and its international verticals in the quarters ahead. So, we find this to be a very attractive valuation and hence our top pick. Moving on to Verano, again, returning top pick. We were disappointed with the company's share price decline of 32.3% in the fourth quarter, though this was a modest outperformance to our tracking group average of 35.1% decline that was seen by the US cannabis peer group. We would have expected a much larger outperformance, as investors should have flocked to this high quality name in a challenging market environment. And for example, as an example of that, Verano's 3 closest peers declined by 20.3% on average. So, doing a fair bit better than Verano did. Verano continues to exude quality. It's got some of the best quality assets in the US cannabis markets. It posted very solid financial performance, one of the strongest EBITDA beats in the Q3 reporting cycle. It's cleaned up its balance sheet and its solid capital position there, and it has clear growth drivers ahead, namely adult use sales in New Jersey and Connecticut in 2023. Importantly, for the year ahead, Verano will demonstrate a rapid shift to positive free cash flow as growth investments wind down and cash flow continues to improve, with new assets coming online and new adult use markets having an impact for the full year. We forecast unlevered free cash flow reaching $150 million in 2023, which would represent a free cash flow yield of 10.1%. And this also includes a free cash flow yield of 16.1% in the second half of 2023 annualized, as the second half of the year should see most of the company's ongoing CapEx projects completed. In terms of catalysts, we're looking for turn to positive free cash flow in Q1 or Q2, Connecticut beginning adult use sales, and we look forward to seeing data on the progress of Verano's on possible M&A announcement as Verano takes advantage of the challenging market conditions. In terms of a valuation, it trades at 4.2 times our 2023 EBITDA estimates. This compares to the large cap peer group average of 6.5 times and Verano's 3 closest peers of 7.4 times, a discount of 36% and 43% respectively. And we don't see any reason for this discount to persist. And so with that, I believe I'll be turning it over to Stefan. Stefan, over to you.
Thank you, Andrew. In healthcare, we're sticking with our same 2 names from last quarter, despite good performance from both of them, namely Quipt Home Medical and Diagnose. The reason is we think both names still have attractive valuations and upside from potential catalysts in the next few months. I'll start with Quipt, which has a target price of $11.75. The stock's already up 20% year to date on some nice M&A news from last week that the market appreciated, but we still think it's got about over 50% upside to reach our target price. So for those of you who don't know the company, they're a US-based distributor of durable medical equipment for at-home care of patients with respiratory problems. So think of things like ventilators for people with breathing problems and CPAP instruments for people with sleep apnea. We like the business because of 3 major drivers. The first is strong demographic tailwinds from the aging population that have consistently driven organic growth in the mid to high single digits, and that's irrespective of the general economy. So this is very much a recession-resistant business because of the underlying need for their products. The second is that it's we like to call it being in an M&A sweet spot due to the industry structure, which is highly fragmented and allows the company to benefit from accretive M&A opportunities, typically paying under 5 times EBITDA for acquisitions. Just last week, they made an acquisition, their largest acquisition to date, a company called Great Elm Health, for about 6 times. But this is a much larger acquisition than their typical tuck-ins, and we think it was a good value for them and accretive. And then the third point is that there's an ongoing shift to home care, which is accelerated by COVID, but will last beyond the pandemic because patients prefer it. and more important than what patients want, it provides cost savings to payers like Medicare because it's cheaper to care for someone at home than in a hospital or in a nursing care center. So the key catalysts for the company are, of course, ongoing accretive M&A, and ongoing proof that they'll deliver on the synergies from its recent Great Elm Health transaction that should allow the company to meet our EBITDA margin expansion expectations, going from about 20% now, 20.5% to over 23% in the back half of the year once those synergies are realized. There's also the potential for further tuck-in M&A that can lead us to increase our estimates. We still think the company has an attractive valuation. It trades at about 5.5 times EV to 2023 adjusted EBITDA, which is a nice discount to its peers at 9 times. So moving to Diagnose, which we have a speculative buy rating, dollar target price. Diagnose is an artificial intelligence company with a platform to diagnose diabetic retinopathy. Diabetic retinopathy is the leading cause of blindness in adults. It occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the retina at the back of the eye, which leads to vision loss. The process is asymptomatic. You don't feel it happening. And the only way to identify the problem before it happens is by taking a picture of the retina with a special camera that are used by eye doctors in grading the severity. So Diagnose has developed an AI system that does this extremely well and efficiently. Their model is a highly scalable software as a service approach where they charge about $5 to $10 per diagnosis. So this is a win-win for eye clinics that charge $30 to $50 for this type of test, since it allows them to see more patients and the doctors to be more efficient and more focused on more valuable procedures. So there are about 450 million diabetics in the world, and they're all supposed to have a retinal exam once a year. So this is obviously a blockbuster opportunity. The company has a number of eye clinics and optical retailers already using and piloting their technology. Their biggest client is New Look, which is Canada's largest optical retailer with about 400 stores. They signed a deal with them in 2021, and they're in the process of installing their software in the stores. Well, this has been going a bit slower than we had hoped. This year is going to be the year where they really do expand across the store base, and we think once they get to a critical mass there, just New Look itself will allow the company to reach cash flow positive. But more importantly, and what has been driving the stock is, in fact, potential other catalysts on the business development front. They've been very active on winning some meaningful contracts, and we're hoping that that'll occur over the next couple quarters. The nearest opportunity for the company is a large 5-year potential contract with the Quebec government to screen 1.1 million diabetics in the province over 5 years. They are in the process they've bid on that project, and they're one of 2 companies involved in the bidding, and a decision on that is expected at the end of January. They're in a very strong position to win that, and that is potential important catalyst for the company, and is probably one of the reasons why the company did so well last quarter when it became clear that there were only one of 2 players bidding on that. The other opportunity is even bigger. It's to do some sort of partnership deal with Essilor-Luxottica, which is the biggest player in eye care space with over 15,000 retail locations. In 2021, they announced a memorandum of understanding with Essilor in hopes that they can finally conclude a deal with the company. We've been waiting for this for quite a while as well. Hopefully something comes to pass in the near term. They're continuing to work on that, and we think this would be an absolute game changer for the company, and obviously a very strong catalyst for the stock. So with that, I'll hand off to David Crystal, who'll tell you about his picks in the retail real estate sector. Take it away, David.
Thanks, Stefan. So in the REIT space, we're bringing back our 2 top picks from last quarter, both of which play on the deterioration of home ownership affordability in the US, which is driven obviously by both very aggressive price increases throughout the pandemic and over the last couple of years, as well as the more recent significant increases in interest rates. So obviously translating into higher mortgage rates. So our first pick is Flagship Communities REIT, buy rated with a $23 US price target. Flagship owns a portfolio of trailer parks in the US Midwest, which operate under a land lease model. So effectively, tenants will own their home, which then sits on a site that they rent from the REIT. So it's very hands-off from the REIT's perspective. They're leasing the land. The tenant is responsible for the upkeep, maintenance, and repairs to their own home. It's a highly defensive industry, which has had a 20+ year track record of generating positive organic growth across all economic conditions. So any concerns of entering into a recession in 23 or beyond, it's a really strong and stable place to be putting your money if you are concerned about upcoming recession. The REIT's offering is also typically the most affordable housing available in their respective markets. And over time, as the tenants build up equity in their homes, they actually become very sticky, which results in a very low physical turnover. So as I mentioned, most of the variable costs are borne by the tenant. This includes utilities expenses, repairs, and maintenance. So it results in a very stable and predictable cash flow profile. And while most years the REIT will push rents by roughly 4% annually, which is $10 to $20 a month increase given very low lot rents. This year, we expect that with elevated inflation, rapid wage growth, and significant increases in benefits, we could see that figure double. Again, it's a very manageable amount. We're talking about a $20 to $40 a month increase, and it is backed by significant wage and benefit growth. So in a nutshell, we see the REIT as highly defensive with strong and predictable organic earnings growth, and it trades at a very attractive absolute and relative valuation. For context, it's currently trading at 13 times forward funds from operations versus the US peer average at nearly 22 times. Now, this is a factor of size, liquidity, and just general lack of eyeballs on the name, but we do think over time, as the REIT grows and gets a wider investor base, this valuation discount will narrow. And turning to our second pick, DSR REIT. This is another returning name, buy rated and $22 US target. DSR owns a portfolio of garden-style apartments in the US Sunbelt with a significant concentration in Texas. Though their market rents have been declining the last few months, the year-over-year increase is still in the mid-single digits, which would be a historically strong showing. And the REIT's mark-to-market opportunity is still considerable following exceptionally strong rent growth in 2021 and the first half of 2022. Earlier this week, after publishing the top pick, we received an operational update. It gave a preview of the quarter and their Q4 leasing activity. We saw blended lifts of 6% and a 130 basis point improvement in occupancy. And this is in what is typically a very weak quarter seasonally in the fourth quarter in the winter. We think this is obviously a good showing for Q4 financial results. We think that will be a catalyst. It also highlights that there's considerable upside left in the rents within the REIT's existing portfolio. And then beyond the existing mark-to-market rent upside, we think fundamentals will remain strong in Texas. The state has outsized population growth, wage growth, and obviously the aforementioned declining home ownership affordability. So we would expect that after a few months of market rents trending lower, come the spring leasing season, we'd expect that this trend will reverse. We'd expect to see higher market rents going forward, and this should support further organic growth over the next 12 to 18 months. And then finally, valuation right now screens attractively versus both the Canadian and US multifamily peer group. The REIT is currently trading at 14 times our forward FFO estimate and a 40% NAV discount. The Canadian peers are trading at 17 times forward FFO at 20% NAV discount, and the US peers at 18 times forward earnings and 17% NAV discount. And we have seen this valuation gap narrow in the past, particularly when it blows up relative to the closest US peers. So we'd highlight this again as a good entry point into the name. And with that, I'll pass it on to Ryan and Gabriel in Metals and Mining.
Thanks, David. So sticking with the theme, we're sticking with our names. So first off, we'll start with Osino Resources, and as Rob mentioned earlier in the call, it was up about 37% in Q4. And really that was just down to, significant project de-risking during the quarter. And chief among those was the receipt of a 20-year mining license for the company's Twin Hills gold project in Namibia. Recall that's a large open pit gold mine that they're looking to develop this coming year. Nothing sexy here, not super high grade, just 3 million ounces of 1 gram per ton in a relatively lower cost jurisdiction. Simple off-the-shelf processing, and like I said, they've just been hitting these milestones, de-risking the project as they moved along. So, and in addition to that, the shares recovered. They were hammered quite severely down into the 50s, 50-cent range. And in addition to the de-risking, they've also removed the deal overhang that was kind of weighing down on the shares. So, late last year arranged up to a $15 million credit facility US. And drew down 5 million of that, and then subsequent to that, completed a private placement of 11.8 million Canadian. So, remove that deal overhang. They're well funded to continue work needed to lead them into one of the catalysts in the first half of this year, which is a definitive feasibility study for the Twin Hills project. So again, de-risking things, applying more real-world economics on that front, and then the DFS will lead into a construction decision immediately thereafter, and then project financing. So in a much better place now to work on that project financing with the shares recovering nicely here. So other catalysts, timing is still a little bit uncertain, but hopefully within H1 of this year is some important land acquisition for the mine itself, where they plan to put the infrastructure and obviously dig the open pit. So they've got the land deals in place with the landowners. They're just waiting for the government to rubber stamp on those. And obviously we all know that when you're dealing with government timing, there can be kind of ephemeral. So hopefully within the first half we get that. And then the other thing is Newmont Mining, which is a major gold miner, came into the picture late last year, and they have completed one of their proprietary geochemical surveying techniques over Twin Hills to kind of get a fingerprint of how do these deposits show up with our technology, with the intention of, okay, if it works, if it shows these deposits that we know about, plan is we'll then go and apply the technique to some newly staked land that Oxino picked up about 100 kilometers along these major productive shear zones that they're on. So they've got about another just shy of 3,000 kilometers that they picked up. And like I said, if proof of concept is shown here, apply it there and see what happens. So, for Newmont, even to allow Oxino to use their name in the press release, I think it's pretty big positive. So we're looking for obviously a very eventful first half of the year, and for the shares to continue on their trend. And then flipping over to, again, a familiar name, Pan Global. So these guys exploring in the Iberian Pyrite Belt, the VMS location in the world. They were up about 30% last quarter, and with copper metal price tailwinds helping them out there. So an important consideration. These guys are still well funded, about $11 million in cash. So good for their planned work in 2023. We acknowledge here that the news flow hasn't been what we would have liked in 2022. We did get news out, but just not the steady flow that we would have liked to have seen. Looking for that to be corrected this year. And, they're off to a good start. They've got 3 drill rigs running at the Escasina project in Spain on up to 8 targets that they're going to test. And they're working on 3 right now. The Romana Deep target is the extension of kind of the flagship discovery there, the La Romana deposit, which, they're on a hole 139 and have yet to miss. So this is a large emerging deposit. It's still growing. They haven't found the ends of it. You can ballpark, say, 40 million tons at about a 1% copper equivalent grade, nice and shallow, amenable to open pit mining, and still trying to find the ends of it, like I've said. So drilling at depth, down dip of that deposit, they've got some nice geophysical signatures down there that they want to test. So they're doing a first pass of 4 holes there. And the first one is done. So hopefully we'll see results in the coming weeks. And then there's some other very large geochemical and geophysical coincident anomalies elsewhere on the large land package they have there. And the two that they're working on now are Zarcita up in the north. That's about a 2.5 kilometer long target with some historic mine workings up in there. And then Canada Honda, which is again, a very large north of 1 kilometer long gravity anomaly to the east of La Romana. And that's how these things are found. These big gravity anomalies, go in, drill test them, and see what's there. So that is the key for this year, is to try and keep this momentum in the share price going, get more news flow out, and then get back up. This was a almost 90-cent stock at about a year ago when they had better news flow. So we're looking for a return to that. So keep it short and sweet. That's it on Pan Global, and I'll pass the torch to Gabriel.
Thanks very much, Ryan. So sticking with what I believe is one of the best resource development stories in silver, GoGold returned 37% in Q4 versus the global Silver X Miners ETF that returned 13.3% for about an even annual performance relative to the silver ETF. That performance was awful low following the sell-off from the GDX ETF in Q3, which pulled the rug under my earlier defense-based call, given the company's large cash balance and the $4 to $5 million in cash flow that it does per quarter from the Peral tailings reprocessing project that supports the company's exploration. The good news is that the company is poised to continue to revalue, particularly as it relates to moving towards building the Los Ricos South project for potential production around 2024 to 2025. Recalling that 2021 and 2022 were all about resource growth, with the recent addition of the Eagle concession at Los Ricos South, which is an unmined high-grade continuation of the Los Ricos South resource, the company will be plowing ahead with moving this project to production as a bulk underground mine instead of a combined open pit and underground mine, which the PEA previously envisioned. An updated resource estimate and updated PEA incorporating that Eagle concession is expected this quarter. In terms of comparables, the Los Ricos South project had about a $300 million NPV estimated in 2021, and that compares to Silvercrest's Las Chispas $486 million NPV in its feasibility study. I expect that the Eagle concession will actually put Los Ricos South in league with Las Chispas in NPV terms. So considering that Silvercrest trades at 1.0 times P to NAV and GoGold trades at roughly 0.6 times, there's a good argument to make for a revaluation as GoGold moves towards building this mine, just like Silvercrest did. But you also have to consider that Los Ricos South is just one of the company's two principal development projects in Mexico. The other one, Los Ricos North, is also expecting an initial PEA out this quarter and a resource update. And that could put a lot of meat on the project and ultimately bring an NPV as big or bigger than Los Ricos South. So ultimately, you're looking at a company that could justifiably double in value over the coming 1 to 2 years, based on a mining project that might cost somewhere around $120 million to build, but for which the company already has $70 million in the bank in cash and equivalents. So there's not much additional capital they need to have to take on to consider, especially since they also have about that $20 million in cash flow coming from Peral. So that's GoGold Resources. And moving on to Silver X. Happily, this was one of the best performing stocks in the top picks portfolio in Q4 with a 72.2% return, which is encouraging since the company had a very slow start to the year. And it also finished the year very well ahead of the global X Silver Miners ETF. For an emerging producer, it's still a very inexpensive stock. It trades at about 0.15 times my NAV estimate versus a small cap junior silver producer's average of about 0.4 times. And on an EV per ounce basis of ounces in resource, it trades far less expensively at just 23 cents per silver equivalent ounce than non-producing silver explorer peers that trade at an average of about 78 cents. So even if you were only to take half of the company's resources, it's still trading near a 50% discount to explorer and developer companies. So very inexpensive in that regard. Now, the key to the story here is a re-rating, which I think is going to come with the initial PEA, which we're expecting this quarter. And that's expected to show the wider property package's potential expansion from a 720 ton per day producer of about 2 million ounces of silver equivalent per year to a 2,250, 2,500 ton per day producer for about 5 to 6 million ounces of silver equivalent per year. And that would be for some time in delivery in 2024, 2025. And this would position the company very well within the junior producer group and set the company up for future company growth. Exploration and district potential is still very much part of the story here, though. They recently identified a gold-bearing structure within the Tangana mining unit, and that could be related to a large disseminated gold target that they found nearby. As a result of this, they're getting a lot more gold than I initially expected would be part of the story. And I think that that's part of the reason why the company did so well this past quarter. They also have two other prospective high-grade silver targets, one of which was formerly in production. And those two targets will be part of what they will fill a potential plant expansion with. This is still ultimately a very young company. I think that it will start turning heads this year, especially after a low-key 2022. And it is still, in my mind, very attractively valued, which is why I'm keeping it as a top pick for Q1 of 2023. So with that, I will turn the conversation back over to Rob Goff.
Or to Amber. Maybe I'll kick off the Q&A. As well, like if anybody has questions, do feel free to email either Rob or myself, or you could just simply use the chat box on Zoom. And I'll start with you, Gabriel. Can you speak to the near-term drivers for the price of silver?
Yeah, look, I think that on a fundamental level, the one thing that is in my mind in particular supporting the price of silver is these easing supply chains, particularly in the semiconductor space, and that plays a lot to silver's role as an industrial metal, not just a precious metal, as well. Given the ongoing transition towards green energy, silver plays an outsized role in the photovoltaic industry. It really is the go-to choice for the connector bus bars and photovoltaic panels, simply because silver is the best conducting metal there is out there. And so those two sort of fundamental industrial reasons are why I'm still very positive on silver. And you also have the situation with the US dollar that has finally been coming off of its peak. That's part of the reason why you're getting support in the price of gold and in the price of silver. So regardless of what happens with the US dollar, certainly if it continues to decline, then the price of silver and the price of gold will continue to increase. But independently of that, you do have that industrial component that might be a little bit more muted than what I would have expected maybe 3 to 4 months ago, just given the sort of global recessionary outlook. But I think ultimately you have very strong fundamentals with it.
Fantastic. Then sticking with metals and mining, Ryan, just back on Osino, what do you think is the significance of Newmont's decision to test its proprietary survey techniques at Twin Hills?
Yeah, I think that really represents a pretty good wild card for 2023. You know, and we're not having to wait around for ages to get this potential catalyst. They've done the survey. Results should be out Q1 of this year. And like I said, if they're positive, they go down the road and apply it to this new Sandveld license that Osino's picked up. So, you know, I think you don't see majors doing this. I mean, Newmont is not being neighborly and saying, oh, hey guys, we're interested in what you're doing. Can we help out? They don't have land in the region. I don't believe they have any operations in the country, period. So I think they're pretty interested. They see Osino, this management's second time around here. They found and developed the Otjikoto mine to the north, which got bought out by B2 Gold back in the mid 2000s. You've got that operation is about 3 million ounces all told, I believe. You've got Osino here with 4 million ounces between their various projects. You've got the Navachad mine, which is about 40 kilometers away from Osino's. That's around 8 million ounces. So these are big regional structures, productive structures. So I think Newmont sees a stable region, and you know, definitely wouldn't just be in there just to see, oh, hey, does our technology work? They want to see if it works and apply it. And I think they've got perhaps bigger plans in mind. So, look for some competitive tension going into the second half of the year once the results on that new land package come out. So I think it's definitely a positive.
Maybe one for Rob, and I see there's a question on the chat, but for Rob, what kind of pushback are you receiving on Converge and Quisitive?
Clearly, the 30% decline in Converge reflects market skepticism. And the skepticism there is at two levels. First of all, is it legit? Is there inbound? And second of all, will there be interest? In terms of legitimacy of interest, the company has followed through with the formation of the special committee. It wasn't at their timing, it was a responsive timing. They've appointed an impressive roster of advisors on the deal here, or prospective deal here. In terms of timing, the company is indicating that they will be releasing preliminary Q4 results mid-February. We would see that as a catalyst for further information to be disclosed. In terms of valuation on a prospective takeover, some felt that our view of a $10 target would be too aggressive. Frankly, do not believe it is when you look at peer valuations. And there it's important that the peers and the potential acquirers have been strong in the marketplace. If you look to the US, the median performance over the last 3 months, it's up 15%. They've got currency. If you look to Europe, the median performance across 7 is ahead 7%. So there is currency. We believe there is interest. And once again, we believe that 17% free cash flow generation draws buyers and draws options. Should it be an unattractive offer, look for a dividend, look for a share repurchase. The Quisitive pushback is one of, aren't they late in coming to market with their payment platform? And our response is yes. What is different this time around is it's much more in their control as opposed to waiting for validation from Visa and MasterCard for the payment processing. That's done. They have the equipment, the supply chain delays. That's done. So we do look for a very strong second half on that name. In terms of the valuation pushback, people say some of the parts, that means it hasn't worked out. What is the catalyst? Our view there is the catalyst for greater traction in the sum of the parts valuation is simply that of raising equity within those two different divisions. That could be private equity in either division that would catalyze or crystallize a value on those assets.
Fantastic. Maybe we could jump to cannabis right away with the question that Mark posed. Regarding U.S. cannabis, is passing the SAFE Act a possibility in the coming year or two, then on the rescheduling of cannabis? Andrew, over to you.
Yeah, thank you. And thanks, Mark, for the question. Listen, the short answer is I think it's unlikely. The details behind that would be that I think there's enough support for lawmakers to pass safe banking, but too many want other items attached to that bill, and that makes it a very complex issue. It's going to be difficult to get the first piece of legislation over the finish line, but once we get there, hopefully there's a clear consensus on how reform should roll out thereafter. Regarding the second part of your question about cannabis being rescheduled, that is actually a process that's ongoing outside of Congress. So we don't need the Safe Banking Act. We don't need any act of Congress. We need an administrative review conducted by the Attorney General and the Secretary of Health and Human Services, both of which act outside of, largely speaking, act outside the political parties. So that review is ongoing. It has started. I expect it will take some time to complete, but we could potentially see cannabis rescheduled within, call it, I don't want to put a definitive time frame on it, but it would be possible for them to move very, very quickly if they wanted to, but most likely 18-month to 2-year time horizon on that. In terms of the implications there, if cannabis is rescheduled to Schedule 3 or lesser, that would immediately remove the 280E taxation penalty that U.S. cannabis companies face. And you could see an almost immediate improvement of about, we're just running the math right now, so I don't have the number in front of me, but it's looking like 40% plus improvement to free cash flow potential for these names. So it would be very material. Thank you again for your question, Mark.
Thank you, Adrian. Maybe I'll jump in here asking a question for Stefan. Stefan, the Great Elm acquisition, that's, if I'm correct, Quip's largest to date. What do you see going forward in terms of M&A activity with Quip, and how do you see the integration of this acquisition?
That's a great question, Rob. Yeah, so it's by far the biggest acquisition that Quip's done. They've typically done tuck-ins, sort of, less than, companies doing $10 million in revenue. To put it in context, Quip, prior to the deal, was doing about 160 million US in top line, and the Great Elm acquisition brought another 60 million in revenue. So it's very big from that perspective. They paid $80 million for that asset. So what it's doing, and it's very important for the company, Quip's obvious ambition is to become a national player. This really accelerates that, and it gets them to a scale advantage, which is very important in this business. Scale is more important than anything, where already they can get price concessions from the leading vendors in the space. So the synergies they're talking about, so on that 60 million in revenue that Great Elm was doing, they're doing about 13 million in EBITDA. Quip believes within 6 months of the deal close, which closed on December 31st, they can wring out another $2 million in cost synergies. On top of that, of course, there's cross-selling opportunities and all that, which would be revenue synergies on top of that. So it sort of checks a lot of boxes for the company, improves its scale, improves its ability to get national insurance contracts, and of course, because Great Elm is in 7 states where Quip was not operating prior to that, provides another regional platform to do tuck-in M&A in the future, which is sort of the end of your question. So it positions the company well to do smaller tuck-in acquisitions in those jurisdictions where they're now operating going forward. Yeah, that's it.
Very good. Thanks, Stefan. I have a question for David. David, we just started introducing 2024 valuation parameters into our comp tables. Can you talk with respect to Flagship? How do you see the growth profile there looking beyond or looking through 2023?
Yeah, thanks, Rob. So it's, as mentioned in the presentation, the sector has historically delivered a 4% operating income growth over a 20+ year time period through all sorts of economic conditions. So, the 2023 growth, I think, is quite unique in that it's driven by inflationary pressure on wages and benefits. So we do expect a very strong 23. Beyond that, I would expect that, unless inflation is a little bit more persistent, I'd expect NOI growth and revenue growth to come back into that 4% range. It should be augmented, though, by the REIT's occupancy upside. There's currently sitting at about 83%. They should be able to take that to the mid-90s, and that'll likely be over a 5 to 10 year period. So factoring in occupancy gains, rent growth, and then obviously leverage, I would expect a longer term growth profile in the high single digits or low double digits. And that's if we're talking FFO per unit growth.
Thank you, David. Now, sticking with the theme of earnings growth, Amber, you mentioned with Echelon that they have 200 million that can be deployed into acquisitions. How might that translate into earnings growth?
Thanks, Rob. Well, they've historically acquired at 6 times EBITDA multiple. So 200 million is theoretically $30 million in EBITDA. Then you contrast that to their last 12-month EBITDA of 65 million. So conceptually, they could add 50% to their earnings without issuing shares. And we love that. Not a lot of growth companies in the small cap world have that optionality. Okay, I think that covers everything for today. We're a little over the 1 hour mark. Where you'd like to follow up with anybody from the team, please don't hesitate to reach out directly. Then the top pick report, the full report is available to you on the research portal. Thanks, everybody.